Welcome everybody to our 1 hour presentation on the Paycheck Protection Program. I'm Keith Mendelson. I am a partner in the Northern Virginia office of Wobble Bond Dickinson, and I want to quickly introduce our two presenters. Stephanie Few is a partner in our Charleston office. She works in the area of economic development with companies seeking economic incentives for their businesses. And Sarah Wilk is a senior associate in our Boston office. She represents small, medium-sized, and large companies on corporate and transactional matters. I want to welcome everybody to this program. Last I saw, we had over 500 people registered for the program, which is an indication of the interest in this topic. I want to make a special welcome to broadcasters from around the country. They were the impetus for this program, but given the incredible interest in this, we decided to broaden it out to a wider audience. I'm going to start with some basics and talk about the Paycheck Protection Program. So the Congress, as I'm sure everybody knows, and then the President signed the Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act, on President signed on March 27th. This is the largest economic relief bill in U.S. history. It will allocate $2.2 trillion in support to individuals, businesses affected by the pandemic and the economic turndown. Many people have questions about how the new law impacts their families and their businesses, and we're going to be discussing part of that today. The Paycheck Protection Program, also known as the PPP, is a loan program that is part of the CARES Act. It actually expands on existing Small Business Administration 7A loan infrastructure. Currently, under the Paycheck Protection Program, $349 billion have been allocated to support small businesses. Just to show how quickly events are moving here, this morning, a couple hours ago, it was reported that the Treasury will seek another $200 to $250 billion for this PPP. And it was reported that that request might go in as early as today and votes in Congress as early as Thursday. PPP loans are available to a wide range of businesses to keep employees and to meet existing payment obligations during uncertain times. And other relief might be available under the CARES Act as well. I want to just briefly mention the various other programs under the CARES Act. We are not going to focus on these other programs, but they are worth mentioning, and people should also pay attention to these. So there are various other programs, including economic injury disaster loans. Those loans are available for qualifying small businesses and nonprofits. There are loans for larger businesses. This is what has been referred to as the $500 billion slush fund. These are intended for targeted lending to distressed sectors. Treasury has a wide discretion with respect to these. We are awaiting guidance on these loans for larger businesses, which are expected to come out any day. And then I'm sure you've also heard about certain tax credits and deferrals that are available under the CARES Act and other legislation. And so we're not going to focus on any of these today, given that there is a lot to talk about under the Paycheck Protection Program itself. With a lot to cover here, we're going to go through some questions and answers in rapid fire fashion, hopefully. Events continue to evolve under the PPP, and so what we are relying on, just so you know, are the statute, the interim financial rules, fact sheets, FAQs issued by the government. And the last of these FAQs was actually issued late last night. So again, another indication of how quickly events are moving. I'm going to dive in with Stephanie and Sarah right now and ask some questions and have them answer, and hopefully these slides will catch up with us. So Stephanie, let me just ask you first, who can be a borrower under the PPP?
Sure, it's an excellent question. There has been a lot of questions about who can be a borrower. And so we know there are a few guidelines. So companies that were in operation on February 15th of 2020 and had employees at that time, borrowers that meet the definition of a small business as defined in the SBA, the Small Business Act, those with 500 or fewer employees in the United States. And that point has been getting some attention lately as well, and as recently as today. So what we understand is that there's a presumption that if a company has 500 employees or less, that they would fall in the definition of who would be an appropriate borrower. There's our slide. This is a lot better than me going from memory. We know we can include full-time and part-time employees. Independent contractors, that came up earlier today. There's still a bit of a question mark about independent contractors. And similarly with nonprofits, we know that nonprofits can take advantage of this program. We know that 501c3 nonprofits can utilize this program. But there is some questions about other, 501c6, some other different designations. And we expect to see some clarity there. And there's also uncertainty about whether or not to include affiliates for purposes of the employee count. Bottom line is, this is a huge piece of legislation that came through very, very quickly. So there are a lot of questions to be answered. And so in real time, a lot of these questions that we all have, that everyone's monitoring this legislation, we expect some more clarity to come. So there's a very long list of who would not be able to be a borrower. So we know, for example, we have financial businesses that are primarily engaged in lending. They cannot be borrowers. Certain things like passive businesses owned by developers and landlords cannot be borrowers. Here's our slide. We also have some businesses with more than 500 employees cannot be a borrower, and then we start getting breakdowns, more specifics of that. But we also know a lot of people are talking about, but what about the hospitality industry, the food industry? Let's go back to who can be a borrower. Those types of industries may lend itself to have employees, but they're spread out in locations all around the country. So there are some exceptions made. If you are in the food services industry, you can be a borrower, or the hospitality industry, you can be a borrower. You aren't ruled out just because you have over 500 employees and you're located in various locations around the country. But we also know, for example, other industries that cannot be a borrower. Life insurance companies cannot be a borrower. And of course, it goes without saying, but it's in the legislation, businesses engaged in illegal activities obviously cannot be a borrower. So there are a lot of rules about who can and cannot be a borrower. There is, that 500 employee seems to be a good baseline. So just like we said, financial businesses cannot, passive businesses, life insurance companies, obviously, those engaged in illegal activities. But we do, as with a lot of this information, expect to continue to see more and more guidance on who can be a borrower under this program and who cannot.
So the affiliation rules under the SBA play a large role in this, and a lot of people have been struggling with these affiliation rules, particularly in the private equity and the venture capital community, but many others also, foreign companies. And so let me ask Sarah to kind of weigh in on the affiliation rules.
And as Keith said, lots of confusion about whether the rules apply or not, and which businesses they will apply to. The venture capital and private equity backed sector of the economy has been pushing to make sure that the affiliation rules don't get applied to them. And there's been some guidance that has made it seem like it does, but then there's also ways to look at what has been released from Treasury and the Small Business Administration to say that if you're under that 500 employee test, that might just be a bright line test, and therefore you could still apply even if you were over that 500 number if you were added with all of your affiliates. So again, lots of uncertainty. A few things that we know for sure, where there are express waivers of those affiliation rules, which I'll go through in a second, what those rules actually are. But the express waivers are for businesses with the NAICS code of 72 that Stephanie mentioned, in accommodation and food services, hospitality type businesses are not subject to the affiliation rules. Franchises, again, similar to the NAICS 72 rule. And then guidance came out that faith-based religious organizations are also not subject to the affiliation rules. So those are
Sarah,
three...
maybe let me just interrupt, and can you just sort of give us a briefing on what the affiliation rules are to start with?
Yeah, absolutely. So that's actually our next slide. So there's what I think of as three buckets of people that get caught up in the affiliation rules. The first is based on ownership. So if somebody has 50% of the equity ownership of an entity, they're going to be an affiliate of that entity, 50% or more. If they don't have 50%, if they, based on straight equity, have less than that, they're a minority shareholder or equity owner, then they may still be considered an affiliate if they have certain rights under the organizational documents of the entity. So the charter, the bylaws, any sort of shareholders agreement that may be in place. If a stockholder has the right to prevent a quorum for the board or the shareholders, or block any action by the board or shareholders, then they may be deemed to be an affiliate. And there's guidance and more information about exactly what actions those might be. But the large concept is if a stockholder can control the management of the entity in terms of their day-to-day business, then that stockholder will be deemed to be an affiliate of the entity. There's also a bucket for management. So if your CEO or president also controls the management of another entity, then that entity will be deemed your affiliate. If a member of your board controls your board, so say you have a 3-member board and one of them has more ability to control than another, if that person also controls the management of another company, then they may be deemed an affiliate. And then finally, the third bucket is based on your close relatives. This is essentially your immediate family unit, your spouse, parents, child, siblings, etc. And if they control businesses with similar or identical business or economic interests, they'll be deemed affiliates. The one key here as well is that any stock options or convertible securities or agreements to merge are treated as though they're current rights, so you can't get around the rules. just by holding options rather than stock.
So as we flip to the next slide, let me just say something else about affiliation. So the Q&A that was issued late last night, early this morning, does address a number of affiliation issues. We will post that on our website under our CARES Act portion of the website, so you can go there. It does answer a few questions, but it raises some other questions, and we're getting these kinds of questions, particularly on affiliation, from a lot of directions. So your particular situation may require some particular analysis. So let's, now that we know, or we think we know, or we're trying to know who's eligible to get a PPP loan, Stephanie, why don't you tell us what the terms of those PPP loans are?
Sure. So the maximum loan amount is $10 million. So that's substantial. So it's easy to see why there's so much interest in this program. Each individual borrower's loan size is going to be based on a formula. And for most borrowers, the loan amount will be the lesser of either, we have $10 million, or 2.5 times the average total monthly payroll cost. And you look at the 1-year period before the loan is made. We also know the interest rate is 1%. That has been moving around a bit, so I would, caution everyone that we'll continue to watch that. But right now, the current guidance is 1%. Maturity 2 years with no prepayment fees or penalties, and repayment is deferred from 6 months from the date of the disbursement of the loan, but interest is accruing over this period. So, tremendously advantageous terms, which shows you how, the companies are tremendously excited and eager to apply for and receive this loan.
So could a company take out more than one PPP loan?
No, no, they cannot. So the companies need to apply for the maximum amount that they're eligible for, but they cannot take out more than one.
So Sarah, I know that the statute and the regulations that have been issued specify what loan proceeds can be used for. Can you kind of walk through that with us?
Yeah, the slide just came up, and you'll see the list there. Payroll costs we'll get into in a little bit more detail in the next slide, but mortgage interest payments, any rent or lease payments, utility payments, and interest payments on debt, all of those things need to have been in existence as of February 15th of 2020. So if it's a brand new lease or utility that you just started, it's not going to qualify. But for anything that was in existence as of February 15th, that will be covered. And then they added guidance that said 75% of the proceeds of the loan must be used for payroll-related expenses. So you need to be thinking of it mostly as a payroll loan, but there is that 25% bucket for other items.
What are the payroll costs?
Yeah, let's go to the next slide, and we'll go right into the payroll costs. So that is what you typically think of as, payroll is your salaries for employees, any hourly wages if you've got hourly employees, commissions also get included, and cash tips. And then it's also your benefits. It's sick leave and vacation, medical leave, group health insurance costs, payment of retirement benefits, all that stuff. But it does have some express exclusions, which there's been a lot of confusion about. So there's an exclusion for any compensation for an individual employee that is in excess of $100,000 on an annual basis. And we just got guidance on that it's cash compensation to the employee. So it's, their salary, it's not their benefits and their health insurance and taxes related to that. So that was good news to get some clarity on that overnight. It also expressly excludes federal income taxes, FICA, those taxes. It excludes the employer side of the taxes. So you want to include the employee's gross wages. So if you're withholding, X amount for that employee, that amount gets included, but not the employer side taxes. It excludes anything for non-U.S. employees. Those should not be included. And then qualified medical and sick leave for COVID-19. There was that Families First Act that got passed before the CARES Act that provided for express medical and sick leave for COVID-19 purposes, and those need to be excluded as well.
And you wanted to touch a little bit more on these eligible uses, so go ahead.
Yeah, great. So funds that you use for these allowable purposes that we just discussed are eligible for forgiveness, but you need to make sure that you have proper documentation of those expenses that you can provide to your lender when you ask for forgiveness, which we'll go into in a second. So our advice is to keep good records of how you're spending the proceeds of the loan, perhaps even going as far as using a separate bank account for these funds so that it's really easy to track where they're going. If funds are used for unauthorized purposes, SBA can require businesses to repay those amounts. If you're using those for fraudulent purposes, they may pursue criminal charges even. So you just want to be sure that you are eligible for the maximum amount of forgiveness that you can be, and therefore keeping good records is really important.
So Stephanie, you told us a few minutes ago about the favorable terms of these PPP loans, but what makes them really exciting is the fact that the whole amount can be forgiven. So we've got a whole bunch of information here on forgiveness, which is important to all of the borrowers. Why don't you take us through that?
Sure. So in addition to the other great terms that we've talked about, obviously it's incredibly important to the companies and exciting and helpful for them that these loans may be forgiven. So the borrowers are eligible for loan forgiveness equal to the amount that the borrower, the company, spent during an 8-week period after the origination date of the loan on qualified uses. And we talked about the things that payroll costs, payment of interest on mortgage, rent, utilities. So qualified uses, but it's important for borrowers to keep in mind that no more than 25% of the loan forgiveness amount can be attributable to non-payroll cost. So when you go back and think about the public policy purposes for this, is to keep people employed, to keep people having their incomes when so many people are losing their incomes. So we want 75% of the funds to be going to payroll costs, and the other 25% can be going to those costs like the utilities, the rent. In that case, if the companies are hitting that breakdown, the 75-25, then it looks like at this time that the loan will be forgiven. As all of these, issues continue to evolve, we do expect to see more guidance. It's also important that forgiven amount of the loan will not count as taxable income. So, it becomes more and more apparent why this program is so very attractive to companies, and it's so important to providing payroll, to supporting our families, our employees during this time.
So there are, Stephanie, circumstances in which the amount that is forgiven will be reduced. Can you tell us what those circumstances are?
Sure. So let's talk about reduction in full-time employees. So we'll start getting into a little more specifics here. So the company will they will compare their average number of full-time employees during the 8-week period after the loan origination, because remember, we're all trying to band-aid this terrible period of time where companies are struggling. So we're looking at the average number of full-time employees during the 8-week period after the loan origination and compare it to the average number of full-time employees per month during either February 15th of last year through June 30th of last year, or January 1st to February 29th of this year. So we're also going to look at another factor, reduction in salaries, because we know that a lot of companies are not able, in a way they're going about keeping their workforce or trying to keep their employees, is by reducing the amount that they're paying right now and keeping their employees employed. So If salaries have been reduced during this 8-week period after the loan origination by more than 25% of the total salary in the most recent full quarter during which the employee was employed before the 8-week period, we're looking at that. And we're also limiting this to employees making less than $100,000. So again, this legislation is trying to focus on the families that need it the most. So there is a cap. So those employees making under $100,000 are going to be where this is looking to help and where we're going to see this benefit.
So just to be clear, even if I take 75% of the loan proceeds and I apply it to payroll, I would be eligible for forgiveness, but the amount forgiven can be reduced for these two purposes: reduction in FTEs and reduction in salaries, correct?
That's correct.
So what if I already laid off some of my employees? What happens then?
So that was an important question because we know as fast as the House and the Senate went, some companies were already having to lay off employees before this came out, and that's continuing to happen. So everyone wanted to address this. So to encourage the employers to rehire those employees that have been let go, borrowers are not going to be penalized for having reduced employment or salary level for any changes made between February 15th of this year and April 26th of this year, so long as those levels are restored by June 30th of 2020, when hopefully things are looking more like normal days by that point. So there's not a penalty as long as you can fall within those boundaries.
So we're going to talk in a few minutes about how to go about getting a PPP, but just to sort of complete this discussion on forgiveness, I've gotten a PPP. I am using it during the 8 weeks that, from the time I received my loan, and so 8 weeks going forward from there, and I'm applying it to qualified uses. How do I go about applying for or getting the forgiveness of this loan? That's
Sure.
you, Stephanie.
So, yes, sorry. So to go about, you would request forgiveness from the lender. The lenders have an extremely active role in this program. And there was, the thought behind that is the SBA realized this is so large and moving so quickly and needed to run as quickly and as efficiently as it can. So lenders are playing a material, crucial role in this. So companies would request forgiveness from the lender. The companies need to include documents verifying the number of FTEs and those pay rates, and also payments of mortgage, lease, utilities. Borrowers need to be prepared to certify that those documents are true and that the loan proceeds were used to keep employees and make eligible payments for the mortgage, lease, utility obligations, and the like. And then the time period is that the lender must decide within 20 days after receiving the request whether or not it rises to the level of that the company will have received forgiveness for the loan.
And then what happens, Stephanie, if I don't use the loan for qualified purposes, or I don't use it during the 8 weeks, or I am subject to some of those reduction issues? So the loan's outstanding. What happens to any portion that's not forgiven?
So for any portion that's not forgiven, that's going to become an ongoing loan obligation that will need to be repaid with interest. Again, so let's look at this slide. An interest rate of 1%, matures 2 years after the issuance. Payments are deferred for the first 6 months. We talked about that earlier, but as we also said earlier, that interest continues to accrue. So that portion that's not forgiven will operate as a normal ongoing loan obligation with the lender. Okay,
so stepping back now, let's talk about the process for getting a PPP. Many people on this call may have already started or gone through that process, and we know that it is sort of also kind of in motion because the lenders are taking different approaches to this. start, Stephanie, with the application process. Can you address where do I apply? When can I apply? Fees? What sort of
Sure.
information do I need? So let's go first to where do I apply?
So we advise, companies to draw on your existing lender relationships. You're going to be applying with the lender, not with the SBA, but you're going to be applying with an SBA approved program lender. And if you look at the SBA's website, they have a list of the participating lenders. So those are insured depository institutions, federally insured credit unions, farm credit system institutions, and other lenders can be added. So start with your existing lender relationship. If that lender is already participating, we're finding that most big banks, many regional banks are participating, but there is overwhelming demand. We know this program is huge. We also know that it's desperately needed and quickly. So we encourage companies to start with the banks, with the lender that they have an ongoing relationship with, because some of the banks are saying that they are only accepting applications from their existing customers, and some are going further than that and saying they're only accepting applications from their existing customers if they have an existing business account. So a personal account may not be enough, but a business account with that lender.
Yeah, let's move the slides forward here. So to the next slide also, when can a company apply for one of these loans? Next slide.
So the answer to when can you apply is last Friday. So in an hour. If you have not applied and you're interested, then you should move very, very quickly. The process began officially on Friday for small businesses and sole proprietorship. Starting April 10th, we see where independent contractors and self-employed individuals can apply. And we say to move quickly because the loans are given on a first come, first served basis. We saw where a lot of lenders were already, they're struggling because this is moving so quickly, but you're seeing some that are saying we've hit our capacity. So this isn't something that, while the program is said to be open and applications can be accepted until June 30th, I would not wait. If this is something that could benefit your company, I would work on it today.
And here might be a good point to remind everybody that Congress is already talking about increasing the amount of the program, and the Federal Reserve has come out with some advice that will make it easier for the banks to give more under the program. So it's all moving very quickly and things may change, but you want to get your part done as soon as you can, but there may be additional opportunities down the road too.
Right. So just to reiterate, what we've been telling clients since last week is there's a lot of confusion on this. The best thing you can do is get with your lender, preferably a lender that you have a relationship with, and start moving right away. Even if some lenders, even if your lender, and we do know that some lenders haven't yet even started taking applications, but get in the queue as quickly as you can. So let's go to the next slide. And Stephanie, just talk a little bit about, fees, personal guarantees, collateral, any of that associated with these PPP loans.
No, so these are very efficient and they're fairly easy. No fees for the loan applications. The SBA is waived fees that you would typically see. They do not require collateral. They do not require personal guarantees. They are backed by the SBA. So you're not going to see quite the level of requirements that you may be used to seeing in a typical business loan.
Which is one of the real advantages of this PPP program, or these loans. So we thought it would be helpful for this group, sort of having covered the sort of general nature of PPP loans, who is eligible, what the terms of the loans are. We thought it would be helpful to walk everybody through what an application will require. And so this is going to get into the weeds a little bit, but I think an important part of the weeds, and we're going to turn this over to Sarah to kind of walk us through this, but suffice it to say that different blenders are taking different approaches to this. So moving to the next slide, Sarah, can you just start off by telling us what information is needed to apply?
Yeah, thanks, Keith. So basically you need three things. You need an application, you need payroll documentation, and you need know your customer information for the bank, which they may already have if you're using a bank that you have an existing relationship with. You just have to kind of work through that with them. The application is available at that website that's included there. You can also, find it if you do a Google. I would caution people to make sure that you're using the updated application form. That's the one that's on the Treasury website. There was a prior version of the form that I think a lot of people are working off of that we've gotten questions on. The easy way to tell the difference on the forms is the old form required had more than one signature line. The new form only requires a signature for an authorized representative of the applicant and not for the 20% owners. So that's a quick way to tell if you've got the old form or the new form. And then the other point on the application form is that lenders may adjust that form. They may add their logos. They may be using an online format and require you to use that. So make sure that you're working with the lender. It may not be as simple as printing off the form from the Treasury website and filling that out and getting it back to them. So make sure you're working with your lender. We'll go through the application form in the next few slides. And I think the other point is we've heard some reports that certain banks are requiring additional information. Really, as Stephanie said before, the lenders are the ones that have control over this program. And so you want to be as responsive to your lender as you possibly can in terms of getting the information that they're asking you for. So we can move to the next slide, which is calculating the loan amount, which is, once you get past the, name of the business type information is the next real box in the application that is necessary. So here you're going to aggregate your payroll costs. You're going to calculate those based on how we previously discussed. It's capping the taxes, it's not including the non-US employees, all those items. And you can either calculate those payroll costs based on your 2019 calendar year or based on the prior 12 months, so trailing 12 months. This was made clear in the guidance that came out yesterday that it's an either or for that. There were different documents that said different things, so there was a lot of confusion on that point, but you can use whichever one you want. So that is helpful. Then you're going to subtract out any compensation that's over that annualized salary of $100,000 that we previously mentioned. We have heard that lenders it's easier if you can see how that money comes out. So when you're running your calculations, having a separate column for the reductions to 100,000 is helpful. And then you're going to calculate your average monthly payroll cost by taking that total amount that you get after aggregating the payroll costs and reducing the 100,000 for each employee that's over 100,000, and you're going to divide by 12. And then there's a second, so that's your average monthly payroll. And then there's a second box on the application form where you take your average monthly payroll and you multiply it by 2.5. That goes back to the test that Stephanie was describing where you get 2.5 times your average monthly payroll. And then you can add in the outstanding amount of any economic injury disaster loan that you may have already received. You can exclude the $10,000 advance on that loan if you received that, but the rest of it will be added in here and converted into the PPP loan. And then the last box in that little section is your number of employees. So that's your count from the very beginning where we were talking about 500 or less employees, depending on what industry you're in and all that. So if we can go to the next slide. The next major section in the application form we've copied in here is this applicant ownership box. You have to list all owners of 20% or more of the equity of the applicant. And obviously, there's only 2 lines in the application form that Treasury published, but if you need additional space, you should just attach a separate sheet, or some banks may have more lines in their online system to be able to add there. But you need this information for each 20% owner. This doesn't necessarily mean that, you know, you will be ineligible for anything, or that the affiliation rules apply or anything like that. This is just a disclosure item. So you want to make sure that you're truthful and that you're including this information for each of your owners. And if there's any explanation needed, you know, just add a footnote or a disclosure item for the banks to take a look at. If we can go to the next slide. There are a series of questions that come up later on in the application. I'm certainly not going to walk through every single one of them. We're getting a little bit low on time here. So really, I just want to focus on that question 3 on this slide, which is the applicant or any owner of the applicant an owner of any other business or of common management with any other business? This goes back to those affiliation rules that we were discussing. So even if you decide that you are not affiliated with a particular company and you are not including employees of that affiliate or non-affiliate in your employee count, you may need to disclose who those companies are and list them here and describe the relationship, and just try to disclose as much as you can and be honest and clear so that you know, you're not hiding anything. And then the other point here is on the non-US employees that you're not including in your employee count and you're not including in your payroll. You may still be disclosing, you know, a foreign subsidiary, for instance, in this response to question 3. And I would just add language to your application to say, you know, we are not including the employees of the foreign subsidiary in our count or in our payroll. Go to the next slide. There's the questions continue. Here, like question 7, for instance, that was updated from the prior application, so it's a little bit clearer in terms of, you know, you're saying that all the employees that you're including in your payroll calculation are U.S.-based employees. They have a principal place of residence in the U.S. So if you if you can't answer that one yes, then your payroll calculation should be adjusted so that you can say yes to that question. We can keep going. There's a bunch of certifications that come up next, which again, I won't go through each of these. You guys can all read them. But basically, the things that I want to highlight are that an applicant is certifying that they are eligible to receive the loan. The SBA and Treasury have, you know, made clear that lenders are not responsible for, you know, whether a borrower is, you know, giving them incorrect information. The onus is on the borrower to make sure that the information is provided and that they are eligible. You're also seeing, I think it's 4th from the bottom, there you're saying that you're only using the proceeds for the purposes specified in the program. That goes back to, you know, what use of proceeds there are. There's also an interesting one that's 3rd up from the bottom, which talks about, you know, to the extent feasible, I will purchase only American-made equipment and products. This was kind of thrown in, and there hasn't been that much talk about it, but just a unique component to think about for some folks. We can go to the next slide. There's a second set of certifications where you actually have to initial next to each one of these. The first few are talking about the qualifications for being an applicant here, where you're in operation as of February 15th, as we previously talked about, that you had employees, that the economic uncertainty of these times are, making it necessary for this loan to be obtained, that you're going to use the proceeds to retain workers and maintain payroll. All of this is just kind of going through what we've talked about previously. There's the not more than 25% can be used for non-payroll costs, shows up in the certifications. There's a certification about not receiving more than one loan. So again, everything that we've kind of talked about before gets recertified here. And then there's the second to last certification talks about everything in your application and supporting documents being true and accurate in all material respects. So you want to make sure you're being careful in what you're filling out. And then you have, like I said before, you have the authorized representative of the applicant sign and date the form. And that's usually going to be, an officer of the company or some other authorized person. So I think that's it for the application.
Yeah, before we get to some takeaways and some questions that we have received up to this point, I do want to focus on one of these certifications. We've had a bunch of questions come to us about, well, what if I really don't need the money? Can I still get the loan? And that makes me focus on the certification that requires your initials here, the one that says current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. So you're going to have to certify that if you are flush with money and you don't need it to support your ongoing operations, then you probably can't make that certification. On the other hand, it's hard to imagine a business out there that isn't being affected one way or another by all the events and uncertainty that is occurring now. So we did get a whole bunch of questions in advance of this, and I know everybody has their individual questions. We're not going to be able to address all of the individual questions on this call, but we will try to touch on a few of them. And we're going to do that now and before we kind of go to our final takeaways. So I'm just going to throw some of these out there and respond to some myself and ask Stephanie and Sarah to respond to some of those also. So a number of questions came up about if we get a loan application in, when should we expect the funds? And let me ask Stephanie, do you have a good response to that one?
I wish I did. That question's coming up a lot. When will I expect to see the money? Hopefully soon. We understand, or we're hearing that it may be May before companies start seeing the money. We certainly hope that it's a lot sooner than that. When you look at the SBA's list of approved lenders, Live Oak is at the top of that list. They've been sharing that they feel like that the loans that they are responsible for will be receiving the money quickly, but we'll have to wait and see. So I think May is what a lot of people are thinking, but everyone is hoping that it's much, much sooner than that because everyone needs it now, not several weeks from now.
And right, when the Treasury Department started talking about this last week, they said, well, the process will open up on April 3rd and people could get money that day. Well, as a practical matter, we've seen that really hasn't happened. And my view is that the timing of when this happens really depends more on you and your lender than on anything else. The faster you can get a loan processed through your lender, the faster you're going to get your money. Sarah, anything to add on that?
I think that covers it. I mean, I've heard one anecdotal response saying from a bank that they were going to get the money out in 7 to 10 days. So that's kind of in the middle of what we were just talking about, whether it's, one day or another month. So it's all over the place. It's the unfortunate answer.
And we have heard that a number of the lenders have either stopped taking applications, or, as I think you mentioned, Stephanie, some lenders are saying that you have to have a business loan with us already. So we've heard the advice, go to the lender that you have a relationship with. But what if my lender won't let me in the door or doesn't participate in the program? Where would you suggest going to try to get this kind of assistance?
It seems like, have a backup plan for sure, because just like we said, even if your lender, perhaps you have an established business banking relationship with the lender, they may have stopped, participating in the program. They may have reached their capacity. So have a backup plan. We know that that's wise. Look through the list on the SBA approved, the lenders that are participating. Look through that list, have your backup plan, and have your information ready, because when you go to another lender with whom you don't currently have a relationship with, that lender may require that you open up a business banking account in some capacity with them. So that's going to take some time. So this goes back to, there is a bit of urgency because there are some hurdles with the lending relationship that you are going to have to overcome before you're able to, for a lender to take your application and process that application. So do your due diligence, have your documentation ready in case you need to open up a new account, business banking account. But go ahead and take a look at the list of lenders so you have not only your own lender that you're going to approach, but a good solid backup plan in case for whatever reason that initial reach out is not successful.
Yeah, and I would just add, we've heard anecdotally that some of the more, smaller local lenders have been a little bit more nimble and flexible in terms of how quickly they can act on this, just due to their size, I think. So don't forget about those folks as you're trying to find somebody else too.
So here's a sort of a specific question that we've heard on a number of occasions, and actually is addressed in the Q&A that was issued last night. But what if an eligible borrower contracts with a third-party payer, such as a payroll provider or a professional employer organization, to process payroll and report payroll taxes? In other words, these are potentially eligible buyers who outsource their employees and their payroll so that the employees actually show up or get their payments and get their W-2s from the professional employer organization and not the company. Let me just answer that since I have this answer right in front of me here. So in the Q&A that was issued late last night, early this morning, the SBA recognizes that eligible borrowers that outsource their payroll can still be considered small businesses here, and they can use the payroll information that the payroll service has to establish their own payroll and to apply for a loan under those circumstances. So they have addressed this issue of those companies that outsource their payroll. Let me dive a little bit more into this affiliation question because it has been confusing, and I have to say that we've spent the thousands of lawyer hours trying to parse our way through how all of this works, and it honestly is still confusing to us. So I'm going to throw this one at Sarah. How would you address the concept of a foreign company that has a U.S. subsidiary, and that U.S. subsidiary has fewer than 500 U.S. employees or employees resident in the U.S.? Is that company eligible for a loan, that U.S. subsidiary eligible for a loan?
Sure. So as we previously said, there's a lot of confusion about this, and I think the guidance can be interpreted in multiple ways. And so our kind of takeaway for folks is to go ahead and apply, to be honest and clear about the fact that you have less than 500 employees that are U.S. employees, and that is how the subsidiary, U.S. subsidiary, is calculating their employee count, and that they are not including the foreign employees that work for the parent company or other companies within the structure that may not be in the U.S. And that, like I said, when we were going through the application, you want to disclose those companies in your response to that, the question on affiliates, but don't let that stop you from putting in your application and working with a lender at this point, just because there are so many ways to interpret what has come out. And we don't want folks to be missing out on, a loan that they may be eligible for.
So the same thinking would apply to, say, private equity portfolio companies. So if a particular portfolio company has fewer than 500 employees and would qualify on that basis, that they should go ahead and apply, even if the affiliation rules would have taken them above the 500, just because we believe that at least there's an argument that the fewer than 500 employees in the U.S. Will not have the affiliation rules apply to that. So in the last minute here, let me just ask Stephanie to go to the last slide and kind of give our takeaways from where we stand today, recognizing that it is still a moving target.
Sure. So like we said, it is still a bit of a question mark when the funds will be made available. We all hope that's sooner rather than later. Move quickly. I would not, don't wait around and think, well, gosh, another fourth stimulus package will come out or more funds will be put into the program. We hope that that both of those things happen, but we can't depend on it. So move quickly. Work with your existing lenders with whom you have those existing relationships. I love this. We say, don't let the perfect be the enemy of the good. This loan program is backed by the SBA. We don't think you're going to see the amount of scrutiny and diligence, perhaps just by the sheer size, need, and timing associated with the public policy reasons for this program. So gather your documentation, do the best you can, complete the application, but don't get so bogged down in the details that you don't move ahead. Disclose how you're calculating if there are any questions. Keep looking out. Look to Womble. We are going to be providing guidance. We're studying this. There's so many updates to come. We're all learning in this together. So know that this is a process that will be evolving. Work with your lender. They have been given wide discretion in this process, so follow their lead. And certainly, we are here to help you, to support companies through this time. We're going to get through this, but we're here to help make that process better for you.
So thank you to Stephanie and Sarah for all of this. And let me just end by saying thank you to everybody who has called in to participate on this. If you have questions, our emails are up there. We will be sending around the slides. Call, get in touch with us, or